Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives that are shaping the global investment landscape. This is the second episode in our 2024 Outlook series. Last week we discussed the macroeconomic outlook and explained why we think 2024 is likely to be a normal year overall, but is likely to provide opportunities for nimble and nuanced investors to deliver returns in excess of market returns. This week we look into our tactical asset allocation and highlight why we are reducing risk in our portfolios at the start of the year, but expect markets to provide opportunities in the later part. 2024 started where 2023 ended, and 2023 ended on a strong note with most assets rallying into the year end. So technically, most assets look overbought, the sentiment is positive, volatility is depressed, and valuations are full. Markets are pricing in strong disinflation to continue and are not prepared for any upside surprises in inflation in the near term. This pricing of the so-called immaculate disinflation creates downside risks in our view. Add to this, cross-asset correlations close to record highs mean that when the tide turns, most assets are likely to post losses in tandem in the near term. But beyond the near term, there are reasons to be positive about the financial market outlook. The primary reason being the history, which suggests more gains for equities during 2024 after the 20% plus return during 2023. Looking at the data since 1988, MSCI All Country World Index gained more than 20% in 9 different years, including 2023. Keeping up the momentum, All Country World Index also posted smaller gains the following year, averaging 4%. Also, during the year of US presidential elections, equities there deliver positive returns, but the gains tend to be more concentrated in the second half of the year. Given this and the changing macroeconomic outlook we described in last week's episode, we propose a more neutral asset allocation for the near term. The table on display shows our allocation between equities and bonds. Please note that while we hold 15% in alternative assets in our strategic allocations, we do not tactically allocate to that asset class. In terms of our recent changes, we downgraded equities to a neutral from an overweight and upgraded fixed income to neutral from underweight. Within both bonds and equities, we trim our active positions to align our tactical positions with that of strategic positions, reflecting our stance on building downside risks in the near term. Within equities, we cut our North American position from an overweight to neutral, upgrade Europe from a significant underweight to underweight by adding UK positions. While we stay neutral Japanese equities, we cut Asia Pacific ex-Japan equities from an overweight to neutral. We also move emerging markets outside Asia to a neutral from underweight by adding GCC equity positions. We keep our off-benchmark position in FX-hedged Japanese equities but trim the same to 100 basis points from 150 basis points earlier. In the fixed income space, we remain underweight developed market treasuries, stay neutral on developed market corporate investment grade and emerging market hard currency sovereign investment grade. We cut our emerging market local currency investment grade position from overweight to neutral. We stay underweight emerging market corporate investment grade and neutral on global high yield. We also introduced an off-benchmark position in US mortgage-backed securities. We're now more neutral on our cash holdings compared to our underweight earlier. In summary, we cut risk by directionally trimming our risk exposures, but also now aligning our tactical asset allocation to our strategic allocations. However, later in the year, we're likely to get a very good point to add risk to our portfolios. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information on our investment strategies, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. Stay tuned for more episodes of our 2024 Outlook series in which we discuss our stance for various asset classes and also the rationale behind the changes we made to our tactical asset allocation. You were listening to the Global Investment Insights podcast from ADCB Asset Management, and my name is Kishore Muktinutalapati.